What's next after I get pre-approved?
Hire a real estate agent. If you haven't already, consider hiring a real estate agent that can help you find homes that match your criteria, negotiate with sellers, and guide you through the buying process. Real estate agent that comes to mind? James Hemphill.
How long does my pre-approval last?
The specific length of time that a pre-approval remains valid can vary depending on the lender's policies and your individual circumstances. However, a common time frame for a pre-approval is about 60 to 90 days. Keep in mind that while your pre-approval letter is valid for a certain period, it does not guarantee that you will get a mortgage loan. The lender will still need to review your financial situation, credit history, and the specific detail of the property you intend to purchase when you're ready to move forward with the mortgage application. Changes in your financial circumstances or credit score can also impact your eligibility for a mortgage, so it's essential to maintain your financial stability during the home buying process.
How much will closing costs be?
Mortgage closing costs can vary significantly depending on several factors, including the location of the property, the purchase price, the type of mortgage, the lender, and other individual circumstances. Typically, closing costs can range from 2% to 5% of the total loan amount, but they can sometimes be higher or lower. Some common expenses included in the mortgage closing costs are loan origination, appraisal, credit report, title and escrow, recording, and prepaid interests. It's important to note that you can negotiate some of these costs with the seller or shop around for different service providers, for example, title companies, to potentially reduce your closing costs. Additionally, your real estate agent can provide guidance on negotiating closing costs as part of your home purchase negotiations.
I use my 401k to buy a house.
Some 401k plans allow you to take a loan against your account for certain purposes, including buying a home. The IRS sets specific limits on the amount you can borrow, usually up to 50% of your vested balance or a maximum of $50,000, and requires you to repay the loan, typically within 5 years. Interest on the loan is usually paid back into your own 401k account. However, if you leave your job before repaying the loan, you may become due in full, and you could face penalties and taxes if you can't repay it. In some cases, you may be able to make a hardship withdrawal from your 401k to cover the down payment and closing costs for a home purchase. However, this is generally considered a last resort and should only be done in case of significant financial need. Withdrawals for home purchases are still subject to income tax, and if you're under 59 and a half, a 10% early withdrawal penalty. Some 401k plans offer special provisions for first-time homebuyers that allow penalty-free withdrawals for down payments. However, you may still have to pay income tax on the withdrawal amount. You can also consider rolling over your 401k funds into an IRA and using a portion of it for first-time homebuyer purchase without incurring the 10% early withdrawal penalty. There are limits and rules associated with this option as well. It is crucial to consult with your plan administrator, financial advisor, or tax professional before making any decisions about using your 401k for a home purchase. They can provide guidance on specific rules and implications of your particular retirement plan, as well as help you understand the long-term impact on your retirement savings and tax liabilities. Additionally, consider alternative financing options and down payment assistance programs to avoid tapping into your retirement savings if possible, as doing so can jeopardize your retirement security. If you have any questions, feel free to reach out. My contact information is below. I hope you have a wonderful day.